Welcome to the FEDLIFE Podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello, and welcome to this episode of the FEDLIFE Podcast. You recognize the voice, I'm sure. I'm your host, Dan Sipe. Additionally, as you already know, I'm the branch manager here at Serving Those Who Serve, Sipe & Associates. I want to begin, as I always do, by saying thank you. Thank you for taking time to listen. We see those numbers going up. It's fantastic. Be sure to share these podcasts. And thank you for your service. You don't hear it enough. You will always hear it here. You are the glue that holds everything together. And the other person who's part of that glue is the guru, Ed Zurndorfer, back with us once again as part of the ongoing mission to reach, teach, and serve you. For my regular listeners, you will know I have to say this next part. At the outset, I need to say the opinions of our guest, Ed Zurndorfer, are not the opinions of Raymond James of Serving Those Who Serve. This podcast is presented for information only and not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. If you do not have a personal advisor, hit us up at Serving Those Who Serve, SWServe.com. We will help you any way we can. Once again, we're following Ed's FedZone articles to give one more way to reach, teach, and serve you. But wait, there's even one more way to learn from Ed, and that is the weekly serving. Every week, we deliver the best of Ed, the best of Jen Meyer, Ed's webinar partner, and the best of Benefits Ben right to your inbox. Don't miss out. See our subscription information on your YouTube page for this podcast. Okay, folks, we told you last episode that we are staying on the challenges for survivors theme. And we will follow Ed's two most recent articles, After a Spouse Dies, Finances Can Suffer, and When to Claim Widower Benefits for Social Security Can Be a Challenge. We know this is not a fun topic, but it's an important one. And I truly believe this is what makes the relationship between Ed and Serving Those Who Serve so special. We want to be the place that covers the tough topics. Do we want every single Fed to be able to plan for a secure and comfortable retirement? Absolutely. And sure, if somebody wants an advisor, love to have that relationship. But most important, we want you to be informed in case things do not go according to plan, because it happens. Okay, Ed, let's jump in. You begin your article with an image that is close to me personally. A Fed has taken the steps to prepare for a financially secure retirement and then suddenly passes away. As you know, that affected my family and was the very real inspiration for Serving Those Who Serve. For listeners who don't know, my late father-in-law was a retired Fed who did indeed die suddenly. There was no plan for that happening. So, Ed, you begin with some stats about spouses passing away. Share those. What are they?
Yes, Dan. This has been my motivating factors for writing these columns over the last month or so about the benefits for surviving family members, particularly spouses. And I came across the following statistic. About 1.5 million Americans become widows and widowers in a normal year. But the COVID pandemic has really increased that number significantly.
Wow.
The National Center for Family and Marriage Research at Bowling Green University estimated that as of November 1st, 2021, 380,000 of the 700,000 people who died in the U.S. from COVID were married. Now, that statistic's been updated. As of today, we're talking about over 1 million people have died, Americans have died of COVID.
Wow.
And let's just say at least 450,000 to 500,000 were married individuals. And we're not talking about people old and gray in some cases.
Sure.
We're talking about young people, Dan.
Sure.
This is very sad. And this has been one of probably my motivating factor in writing these columns. I want to take it one step further. When I've been teaching federal retirement seminars, now webinars, for over 25 years. I started about 25 years ago.
Yep.
And when I give a presentation for my seminar, I talk about, if you want to retire, I have 3 tests for retirement. 3 tests for retirement. And you must pass all 3 tests in order to retire, my opinion. And what are those tests? One is the financial test. Can you realistically, financially afford to retire? Please be honest with yourself. You have to run the numbers here. You got to make sure that you're able to pay your bills. The next test has nothing to do with money. It deals with one's sanity.
Got it.
If you reach the point of your career that you are eligible to retire, but you're not very happy in your job, you don't like to come to work or work from home now, I guess. You don't like the nature of your work, maybe the politics, whatever the reason is. And you're eligible to retire for the sake of your sanity. I call it the sanity test, retire.
Gotcha.
And the third test does deal with money. I call it the pillow test. What is that all about? If you're a married person, particularly, you're a married federal employee, and you are losing sleep over what could happen, particularly to your spouse, if you were to die. If you're losing sleep over that issue, you are failing Zurndorfer's pillow test.
Gotcha. Ooh, we need to trademark that.
Because
Sorry.
That's okay. No trademark. You have my permission. Please use it.
Okay.
Just to make a point here.
CPT.
That you have to, as a federal employee, have to be well aware of what's going to happen to the finances of your family, particularly your spouse, if you were to suddenly die. So
no, that makes sense.
That's why COVID, what's happened over the past couple of years with COVID and the young people dying. That's why I wrote all these at least 4 or 5 columns on survivor benefits. And they're going to continue, by the way, Dan. I have a few more coming up in August.
Gotcha.
Okay. So
one of the first points that you make is there's a change in tax status, which makes perfect sense. But again, a lot of folks may not automatically think about that.
Yes, Dan, as you know, I have accounting and tax practice, and I'm very sensitive to taxes. I tell my clients, you have to pay the taxes that are due, but that does not mean you have to pay more than you really have to. There are things you can do to minimize that tax liability. And I'd just like to review some facts here, because the information I'm going to present now may affect some people. It doesn't affect all people, but it may affect. I just want to give some general information. In the year of a spouse's death, that year is the last year in which a married couple, one of the spouses of the married couple died, but the surviving spouse for that year can file married filing jointly because their spouse was alive for at least one day of that year.
Got it.
As many people know, married filing jointly tax rates are generally better than married filing separately. And basically, it's going to be cheaper when the overall tax liability compared to if we took 2 single people and added their incomes together and then figure out what their joint tax liability would be.
Makes sense.
Okay. But after the year of death, the surviving spouse cannot file as married filing jointly.
Gotcha.
If there's no dependent children. If they have dependent children, then they can file as what's called qualifying widow. But we'll put that aside. Just say it's just one. The surviving spouse is going to be the only person there. There's no other family members. They have to file as single. This is in the year following the year of death.
Gotcha. Okay?
The problem is that the tax rates for single, the tax brackets are, don't line up like with the married filing jointly. And I think it's a lot easier if I cite an example here because what I'm going to be leading up to is there's something called the widows and widowers tax penalty.
Gotcha.
And let me illustrate through this example. And this is in my column, which came out in July at the end of July.
Yep.
We have Carl. Carl is a federal retiree.
Mm-hmm.
and he was married to someone named Janet until Carl died suddenly in November 2021. During the year 2021, Carl and Jeanette had taxable income for the year of $280,000, putting them into a 24% federal marginal tax bracket.
Gotcha.
Now remember, for the year 2021, Janet, the surviving spouse, can still file as married filing jointly. But now it's 2022. And Janet has to file as single.
Got it.
Turns out her taxable income, and the names have been changed, but these are clients of mine. Carl was a client. The names have changed. But Carl and Janet were clients of mine. Janet still is, and she came to me last month for some advice for this year's taxes. And I projected ahead. So Janet has to file as single this year, I told her. She goes, "Oh, that should be good." I said, "Well, let's find out." And I went through her taxable income. It's going to be reduced to $175,000. That's taxable income.
Gotcha.
So they have gone from $280,000 taxable income in 2021 rather, putting them in a 24% federal marginal tax rate, married filing jointly. And Janet in 2022, with taxable income of $175,000 filing a single, it's going to put her, I hope you're ready for this.
I'm sitting down.
A 32% federal marginal tax bracket.
Ouch.
She's been pushed into the next bracket.
Boy, that's really insult to injury.
I'm glad that Janet came to me.
Sure.
Because there's some things maybe we can do to maybe not put her into a 32% tax bracket.
Gotcha.
Maybe put her back into a 24% bracket. Because we still have time.
Sure. Now, next you talk about step up in cost basis. And I think a lot of spouses miss this because they don't think it occurs between spouses. They tend to think about it if they're passing stuff to their kids. So, and this is for non-TSP, non-IRA, non-401k assets. So take us through that.
Okay, Dan, under current IRS rules, the estate of an individual who dies with assets held outside of retirement accounts, for example, they own a house, real estate jointly, they own stocks, they own bonds, open-ended and closed-ended funds, gotcha. ETFs, the general investment stand.
Sure.
When they hold these assets as joint owners with rights of survivorship. Okay. So when the first spouse dies, then the surviving spouse, who now is going to inherit the deceased the portion of that asset, the 50%, will not owe any appreciation on the portion that they're inheriting. Example:
gotcha.
Two spouses bought XYZ stock 10 years ago for $50 a share. We'll use one share.
Yep.
Each spouse's cost basis is $25, half. Then the one spouse dies this past year, at which time the value of that stock has increased from $50 when they bought it. It's up to $1,000 a share. So what is the cost basis? What is the cost basis now? $500 for each spouse.
Gotcha. So
when the first spouse died in 2022, their cost basis of $500, the surviving spouse is going to inherit that $500 cost basis. It's going to be added to their cost basis. In other words, the surviving spouse does not have to pay capital gains tax on the difference between the $500 cost value and the $25 cost basis of the deceased spouse. It's just added to their cost basis. So what's going to happen is the cost basis now for the surviving spouse will be increased from originally it was $25. Now we're going to add $500 to that. So now their cost basis has been increased. It's been stepped up to a total of $525. Okay. That is a big boost for the surviving spouse, because otherwise, if they would sell the stock tomorrow, let's say for $1,000, if they didn't get the step up in basis, their capital gain would be the difference between $1,000 and $25, their basis, but they got to step up. So the cost basis is the capital gain is what, $475 rather than being $975. Big difference.
Now let's loop back to those TSP, IRA, and 401k assets. So we've got some rollovers to do here, right?
Yes. Surviving spouses are eligible to directly transfer inherited retirement accounts, this includes, Dan, traditional IRAs, Roth IRAs, TSP, both traditional and Roth TSP, 401k plans, 403b plans, or 457 qualified retirement plans into their own retirement accounts. In other words, it goes into their account under their name. Okay. But this is doesn't always make sense. There's sometimes It does make sense. Sometimes it does not. Let's go through some examples where it does not make sense. Suppose the surviving spouse is younger than age 59 and a half.
Mm-hmm.
And their spouse, let's say they were 50 years old, and their spouse at the time that they died was, let's say, 55. And the deceased spouse had a traditional IRA. Well, the surviving spouse decides, well, because I'm eligible to transfer all that traditional IRA into my IRA, I think I'm going to do that. This way, it'll be all under one roof.
Gotcha.
Well, here's the problem. Since it's all under one roof in the name of the surviving spouse, who is younger than 59 and a half, until when does the surviving spouse have to wait to take that money that they rolled over from their deceased spouse's IRA into theirs, until how long they have to wait to start taking money out?
Till they're 59 and a half.
That's right. Whereas if they kept it in the name of the deceased spouse, they can make penalty-free withdrawals from their deceased spouse's account. I repeat, they can make penalty-free withdrawals, and they can actually draw it out over their life expectancy, even under the Secure Act, because a spouse is what they call an eligible designated beneficiary, meaning that, yes, they do have to take the money out of the inherited IRA, but they don't have to take it out within 10 years. They can spread it out over their life expectancy. I emphasize again, even though the surviving spouse is younger than 59 and a half, and they decide to leave their inherited IRA from their deceased spouse in the name of the deceased spouse, they can take the money out over their life expectancy through what's called an inherited or death IRA.
Gotcha. No, that's an important point, Ed, and that's something a lot of people would miss. So that's a great thing to bring up. Okay, so the surviving spouse is now going to be addressing, tax withholding and estimated payments where they might not have been handling that before in the relationship, correct?
Yeah, that's correct. I mean, the general rule is this, Dan, and this applies to anybody, that individual tax filers have to pay the IRS. They have to pay in through withholding.
Yep.
From their paycheck, withholding from their annuity payment, withholding from the TSP. we're talking about federal tax now. States have their own rules, but we're talking about federal now, IRS. You have to pay in at least 90% of your anticipated taxability, or 100% of last year's the previous year's tax liability, by December 31st, or if you're making an estimated payment, you have until January 15th to pay in the total amount due to reach that 90% level. Okay.
Gotcha.
Let's say the spouse who died paid most of the withholding or estimated tax payments. They were responsible. Okay. In order to meet the couple's joint income tax liability. Okay. But the spouse died early in the year, like in April or May. So the surviving spouse has to make arrangements for the rest of the year, what they're going to do in order to meet that 90% tax liability. They're going to be responsible, let's say, for making estimated tax payments or changing withholding. The surviving spouse is going to be getting, let's say, a survivor annuity. CS rest refers. They can make arrangements to have federal and state taxes withheld from their annuity. They're going to get maybe TSP payments. They can have federal income taxes withheld from their TSP payments. They have an IRA. They can make arrangements to have federal and state tax taken out of their IRA distributions. In other words, it is now up to the surviving spouse to make sure that for the year, because remember we've said earlier that in the year of death, the surviving spouse can still file married filing jointly.
Gotcha.
So the surviving spouse is responsible to make sure that as filing married jointly, that their joint tax payments that they made, withholding, estimated tax payments, are at least 90% of their anticipated liability for the year. Okay.
Gotcha. And they're also, we touched on this a little bit earlier. They're going to be dealing with filing the tax return now,
yes,
in the year of death, and then a change the following year.
Dan, talking about that, one of the rules I have in my tax practice is that if I get a request to do a tax return from a married couple, and this is many times happens, one spouse is responsible, the other spouse has no interest.
Got it.
I say, I'm not going for that.
Good for you.
I'm not going for that. I'm not going to take on as a client. And they say, why? Because number one, it's a bad thing. You both should know what's going on when it comes to your taxes.
Yep.
That's number one. And number two is, if there's a problem, you have some problems, and that spouse who's responsible for taxes brings in the problem, and I explain what the problem is, and then you go home and tell your spouse, and the spouse says, I don't think you know what you're talking about. You didn't hear that. and in this case here, if the spouse who was responsible for doing the taxes, for making sure the taxes were done, they came to me with all the records and things like that, dies, then what is the surviving spouse going to do?
Yep. Crash course, and that's a bad way to learn.
Exactly.
Yep. And it's a great segue. Folks, please have these conversations with your spouse now. And I'll share something. I try not to keep a lot of walls on things. Last week, I was in the hospital for a medical procedure. Thank God everything went okay. But my poor wife, I was wearing her out in the 2 weeks leading up to this. And I don't even remember, this is how this works, and this is how that works, and these are the passwords and everything else. And I really, I'll say to you what I said to her. Okay. I never want my spouse to have to learn these things while bereaved. I lived that with my mother-in-law. Okay. I was there to help her. Thank God. Didn't know that much, but was willing to learn. But I lived that. It's terrible. Take steps now. It might be uncomfortable. Again, my poor wife was so patient with me. But then I said to her what I'll say to you. It's truly another very important way to say I love you. You're important to me. I want to make sure you're taken care of if I'm not here. So please, folks, if you listen to this, talk to your spouse, share it with friends. This is not a fun podcast. but it could make a huge difference for you. All right, Ed, let's talk about the challenges of when to claim Social Security benefits as a surviving spouse. You begin with a very real example of two spouses each have their own record for Social Security. So we have two payments that will now drop to one. So what is our survivor faced with here?
Well, I just want to mention, Dan, and column I wrote, it's coming out, I believe, this week.
Yep.
That in this day and age, it's not so uncommon that we have a married couple in which both spouses have worked long enough, have earned enough, earned enough to be that in which wages were subject to Social Security tax, to the extent that both are getting very nice amounts, are eligible for very nice amounts of monthly Social Security retirement benefits. In other words, the rule has always been under Social Security that if we have a couple in which one spouse is what I call the higher earning spouse, and the other spouse is the lower earning or the no earning spouse. Let's say that the no earning spouse was a stay-at-home dad or mom. That when it comes to Social Security, that if it turns out half of the higher earning spouse's Social Security is more than all of the lower earning or no earning spouse, then the low earning or no earning spouse can get half of the higher earning spouse's Social Security. That's always been the law.
Gotcha.
But now that doesn't seem to be always the case. It's far from it, because now we have both spouses working. So each is entitled to receive their Social Security own benefit because their own benefit is more than half of the others. And when they're drawing their own benefit, in so doing, they will maximize their lifetime benefit from Social Security.
Gotcha.
But what happens when one spouse dies? Now, I face these questions a lot from couples. They ask me, am I ready to retire? Are we ready to retire? I talk about, I like to see your income, things like that. And typically I met with couples, not so much now, I'm not doing as much as I used to, but typically both spouses have worked long enough, they're getting their Social Security, to decide that they're going to start drawing it at their full retirement age, maybe, so they can get the no reduction. I said, fine. And I say, have you worked out what's going to happen when one of you dies? What are you talking about? When one of you dies, there's going to be one Social Security check. And they say, well, wait a minute. We heard about when it comes to a pension, a CSRS annuity or a FERS annuity, that when I die, or a military pension, that you choose a survivor annuity, then your surviving spouse is eligible for as much as 50% of what the retiree, military retiree, federal retiree is getting at the time of his or her death. Yes, that's true. But that's not true with Social Security.
Nope.
Both spouses are drawing their own Social Security. One spouse dies, their Social Security is done, finished.
Yeah.
So the surviving spouse will get, as far as Social Security benefit, they have a choice to make. They could continue to receive their own Social Security, or if it turns out that their spouse's is higher, it's more, they can choose to take that one. It's called a Social Security widower benefit. It's the full amount of deceased spouse's Social Security at their full retirement age. And they'll get that check. But then their check is going to stop. Their own check is going to stop. You're not going to get two checks.
Sure. Yep. And Ed, you also give us a list of the 4 Social Security survivor benefit options. Why don't you run through those real quick?
So here are the scenarios here. Let's take the first scenario in which both spouses are drawing their own Social Security. They started at age 62.
Okay. So that's scenario 1.
one spouse dies and the other spouse, the surviving spouse, has a decision to make because they're over age 60. Should they apply for the widow benefit?
Gotcha.
The widow benefit at that point,
Mm-hmm.
and stop their own benefit. Now, keep in mind, though, that by starting at age 62, that surviving spouse's own benefit has been reduced because they're starting it before their full retirement age.
Yep.
They could start the widow benefit at that point, but the widow benefit will also be reduced because they're under their the surviving spouse is under their full retirement age.
Gotcha.
So maybe the thing to do, what they run to, as you run the numbers, the surviving spouse, is to stop their benefit,
Mm-hmm.
get the widow benefit, the widower benefit, even though it's going to be reduced, and then delay their own benefit until age 70. Because once the surviving spouse reaches their full retirement age, at that point, for every year thereafter, they wait to take their own benefit, their benefit will actually increase by 8% per year.
Gotcha.
So that's one scenario. Another scenario would be in which, let's say, the surviving spouse, both were getting their own Social Security, or let's say one spouse was taking Social Security, their own Social Security, and they started, let's say, at their full retirement age, and about a year later, their spouse dies.
Mm-hmm.
So the question is, should they now switch to the widow or widower benefit starting now? And there will be no reduction because they're over their full retirement age. Well,
Gotcha.
In that case, it probably makes sense to switch to the widow or widower benefit, even though it might be less than their own benefit. And the reason I'm saying that, Dan, is that if you delay the widow or widower benefit past your full retirement age, you're not going to get any increased benefits. You're not going to get these 8% per year, what's called delayed retirement credits.
Makes sense.
The delayed retirement credits only apply to your benefit. So in that case there, you're best off stopping your benefit so that it increases 8% per year until age 70, and then switch to the widower benefit.
Makes sense.
Okay. So there are different options there, but I also want to point out that if you're younger than full retirement age and still working, be careful, because Social Security has a rule that if you're drawing any type of Social Security retirement benefit and you're younger than full retirement age and you're still working, you can only earn a certain amount each year in Social Security covered employment. Most jobs now are covered by Social Security without losing your Social Security benefits you're receiving. In particular, this year in 2022, for anybody who is younger than their full retirement age, between age 62 and their full retirement age, and that would come down to anybody born in 1957, 1958, 1959, and 1960. You're between 62 and your full retirement age.
Sure.
This year. If you're drawing Social Security benefits, whatever benefit it is, your own benefit or you're receiving a widower benefit, and you're earning, your salary is more than $19,560. Listen to this.
Yep.
For every $2 you earn above $19,560. For every $2 you earn above $19,560, Social Security will take back $1 of your benefit.
Gotcha. Ouch.
I did the numbers here. That means if you're earning if you're earning more than about $53,000 this year, you're going to lose all your benefits. That should be a consideration.
Sure.
Once you reach full retirement age, you can earn as much as you want. There's no more earnings test.
Gotcha. And for most of the folks listening to us, I kind of did the math. Most of our listeners, that target is going to fall between 66 and 67 for that full retirement age.
Yeah. If you're born in 1956, your full retirement age is
yes.
66 years and 4 months.
Yes. I happen to know that one personally. Yes, I do. All right. And lastly, you cover something a lot of folks miss, and that is there's a Social Security benefit for former spouses or from former spouses. Walk us through that.
Oh, yes, Dan. If someone was married to an individual for at least 10 years and been divorced from that individual for at least 2 years, and it turns out that the ex-spouse's Social Security is a lot more than your Social Security. In other words, half of theirs is more than yours. You would be allowed to draw on their Social Security, getting half of theirs under the following conditions. Number one, you didn't remarry. You're single. Number two, you were at least age 62. And your ex-spouse is at least 62 years old. Now, I'm bringing this up because this requirement to receive half of your former spouses is not the same as if you're receiving half of your spouses. The rule is for spouses, if you want to draw on half of your spouses, assuming that half of your spouses is more than yours,
sure,
your spouse has to be drawing.
Gotcha.
If your spouse is not drawing, you cannot draw on half of theirs. That is not the case with former spouses. The only rule is for a former spouse is you must be at least 62 and your former spouse must be at least 62. And it makes no difference if your former spouse is drawing or not. Mm-hmm. This can also invite some good opportunities for planning when it comes to former spouses. I'd like to relate the story of a client I have. I do her tax. I've been doing her taxes for many years. And for all the years I knew this client, she was single. About 5 years ago, she came, she wanted to see me. She wanted to talk about starting to receive her Social Security. She's 66. She was turning 66 years. It was about exactly 5 years ago, August 2017. She's turning 66 years old.
Gotcha.
And she comes to see me in July 2016, and she says to me, I'm thinking about drawing my Social Security. Now, I knew for a fact she was still working. Very good job, excellent job, good income, definitely entitled to a very good Social Security retirement benefit once she starts drawing it. And also, like I mentioned, once you reach your full retirement age, you can draw Social Security, continue to work, and not lose any of her benefits. Great. So her question to me is, should she go ahead and start drawing her Social Security as of the month she turned full retirement age?
Mm-hmm.
I said to her, do you really need to? Do you have enough income? She said, yeah, I have enough income. I really do. I said, what would be the purpose of you drawing Social Security? You realize that most of your Social Security benefit will be included in your income. It's taxable. He said, well, I can always take the money and invest it, reinvest it. I said, okay. That might be a reason to do it. But I did have one more question for her. For all the years I knew her, I've been doing her taxes for 20 years. She always filed as single, but I felt obligated to ask her the question, Dan, were you ever married? And her response was, yeah. It was not exactly a yes. She sort of dragged it out. There was a little hesitation.
Sure.
And I said to her, could you tell me about your former spouse? Oh, he is, not was, a telemarketing executive. For all the years I knew him, and he's still working, he had a 6-digit salary. He is now 68 years old. He's over 62.
Sure.
Dan, when she told me this, my eyes are rolling. I'm thinking, oh, this is going to be great. I got a great plan for her. Here's the plan. You draw on half of his. And she said, will he have to know about it? No. He doesn't know about it.
Doesn't get a vote.
And I want to emphasize, it's going to take nothing away from his Social Security. Somebody could have been married 5 times, 5 different spouses, married to each spouse for at least 10 years. They're each going to get half of his.
Gotcha.
But taking nothing away from his. I know for a fact that half of his is going to be more than yours. But here's the most important point I said to her. If you're drawing on half of his, you're 66 years old now, and you wait to take yours Social Security, your own Social Security, until 70, which is the last age they're going to give you what's called these delayed retirement credits. Your Social Security benefit will be 32% more if you started at age 70. So the plan is you apply for half of his. You have to contact Social Security. You have to have your birth certificate. You have your marriage license, your divorce decree, and they'll take it from there.
Yep.
Only one more question, though, Dan. I have to ask her. How long were you married to him?
Yep.
I hope you're sitting down, Dan. Because when I heard her answer, I fell off my chair. You know what she said to me? I was married to him for 9 years, 10 and a half months.
Oh, no.
What did I say? What's the minimum time you have to be married?
10.
10 years. She missed it by a month and a half.
Ugh.
I said to her, why didn't you stick it out for 10 years? And what was her answer? Because my divorce attorney knew nothing about Social Security benefits. You talk about a catastrophic failure here. I mean, I would have sued that attorney. That's so basic. The attorney cost her.
Ouch.
Social Security benefits. And we're talking now, Dan, a sample of what people have to know about Social Security. And if I can, with your permission, make a pitch here.
Absolutely.
For our webinars.
Absolutely.
One of the webinars we do at Serving Those Who Serve, it's open to anybody.
Yep.
You don't have to be a federal employee. We have a Social Security webinar.
Right.
Social Security webinar that is held every other month. We don't hold them every month. We just had one last month in July. Yep. Our next Social Security webinar, I have the dates, will be held on September the 16th.
Yep.
The one after that will be held on November the 10th. All you got to do is sign up. Go to www.stwserve.com. Just click on webinars and sign up. It's free. You can attend as many times as you want. You can ask questions.
Absolutely. Live Q&A.
And you'll learn everything you need to know about Social Security.
And folks, even though it's not, exclusive to feds, it's going to definitely have a Fed flavor because that's our focus. So if you're coming in from the outside, you're probably going to hear some things you don't know about that are in the cross reference. So, all right, that wraps up our discussion for not fun topics for today. And I will again make a request, share this information, share the article, share the podcast, check out the webinar, not just on Social Security, but on survivor benefits. We can make sure that the information is here. I ask you to help us share it. In the social network information age, you are a key player in the overall good. So share. That is it for this episode. Ed, as always, thank you. Thank you for what you do for us and for the federal community, especially for what you teach us as a team. We're very blessed and grateful for that.
My pleasure, Dan. Thank you for having me.
And we are Serving Those Who Serve. Be sure to subscribe to this podcast on our YouTube channel and Spotify. Remember to share it with friends and strangers. Check us out on Twitter and LinkedIn. Don't forget the live webinars every week. As Ed just touched on, go to stwserve.com. You will see the blue webinar button. Hover over it. It turns red. Click it. You go right to the landing page. The guru comes to you. Sign up for one, sign up for all. Share the page with your friends. They will thank you. And be sure to read every week in the Fed Zone at blog.stfserve.com, but also at fed-zone.com. And do not forget, as you come out of here, sign up for the weekly serving. Ed and the other Fed stars from SWS come straight to you. So for Ed, the crew at Serving the Serve, and me, Dan Sipe, good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FEDLIFE Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.
Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.